Let's talk about issuing stock. What we are concerned about here is when a corporation issues new shares of stock to people. We are not talking about when stockholder A sells their stock to stockholder B. If stockholder A sells their stock to stockholder B, does that affect the corporation? No, it affects stockholder A and stockholder B, but not the actual corporation. So we're talking about the corporation issuing new shares of stock. Typically, the stockholders would pay them in cash, although we'll see there may be other possibilities as well. So we're not talking about the trading of stock, we're talking about the initial issuance. We're going to start off talking about issuing stock that has a par value, and we're going to assume that we receive cash when we issue that stock. Let's go back to Chapter 2. When we first started making journal entries, one that we made a good bit was when the owner gave money to the business and the business gave that individual shares of stock. We issued stock to the owner. What did that look like in Chapter 2? What did we debit? Cash, good, to make it go up. What do we credit? Capital stock is what we called it back in Chapter 2. We debited cash and credited capital stock. We're still going to debit cash for what we get. What we're going to do now, though, is we're no longer going to use the account called capital stock. Instead, we're going to have two accounts that take its place. One is called common stock and the other is called preferred stock. Because there are two types of stock. We'll no longer credit capital stock, we'll credit common stock or preferred stock. However, my credit to common or preferred stock is going to be for the number of shares times the par value. Common or preferred stock then are my new accounts in my book. They take the place of capital stock. They are capital or equity accounts, therefore they have a credit balance. They make up what's called the legal capital, and the legal capital is an amount that we cannot pay dividends out of. The idea is that it remains in the corporation then to protect the creditors. Hopefully when we issue stock, we will receive more for it than the par value. So if the stock has a par value of $5 a share, but when I issue it I get $6 a share. The extra amount it takes to make that entry balance goes to a brand new account called paid in capital in excess of par. Paid in capital in excess of par. Now, you're welcome to abbreviate paid in capital as PIC. The rest of it we're going to have to write out. What does it mean, excess? More than. This is paid in capital more than the amount of the par value then. And yeah, this is a long account title, isn't it? Back in Chapter 2, I even made a point of telling you that account titles were short and sweet, and they were back in Chapter 2. Now we're going to get some that have a little bit more length to them. Paid in capital in excess of par. Paid in capital, what type of an account does that sound like? Capital, credit balance. Paid in capital in excess of par is capital or equity, and it's going to have a credit balance. We would mark that as either being common or preferred. So we'd have a PIC in excess of par for my common stock. We'd have a PIC in excess of par for my preferred stock, two different accounts. So here's my journal entry to record issuing stock. Debit cash for what I get. Credit common stock or preferred stock for the number of shares times the par value, and the extra credit goes to PIC in excess of par. Let's do an example. We issue 1,000 shares, $2 par value, common stock, and right now we're going to issue it for $2 a share. So it has a par value of $2, we're going to issue it for $2 a share. Will there be any paid in capital in excess in this case? No, we're going to start off with a simple example. What do I have more of? Cash and asset goes up with the debit. Let's debit cash for $2,000. And what else do I have more of? Chapter 2, we would have said capital stock. Now we're going to say common stock. We'll never use the account capital stock again. It is now common stock or preferred stock. My credit to common stock is going to be for the number of shares times the par value, which in this case is exactly what I got for it. So debit cash for what we receive, credit common stock for the number of shares times the par value. In this case, they are the same. Let's do another. We issue 1,000 shares, $2 par value. This time, though, I get $10 a share when I go to issue it. You'll recall that we said the par value is basically a meaningless number. It's a fairly arbitrary number. It has some legal significance, but it bears no relation to the market value. We might have a 1 cent par value, and our stock might be trading for hundreds of dollars a share. There's no relationship between the two. Do we have any excess involved in this case? How much per share? 8. $10 we got for it, minus the $2 par value. 10 minus 2 is an $8 excess. Let's make a journal entry. What do I have more of? Cash. How much cash? Well, 1,000 shares, $10 per share. I'm going to get $10,000 cash. What else do I have more of? Common stock. My credit to common stock must be for the number of shares times the par value. So I'm going to credit common stock for $2,000. That doesn't balance. To make it balance, I need another credit for $8,000, and that goes to our new account called Paid in Capital, PIC, in excess of par. Now there are two ways to figure that amount. One is you could say I get $10,000 for it, subtract the $2,000 par value, and that will give me my $8,000. The other way is to take the $8 excess per share times the 1,000 shares, gives you $8,000 also. Either way is fine, they're going to give you the same answer. Now let's issue 10 shares, $5 par value, common stock for $80 in total. I didn't tell you how much we issued it for per share. Well, 80 divided by 10 says I must have gotten how much per share? $8. And it has a par value of 5. I want you to make that entry for me, please. What do I have more of? Cash. I have $80 more cash. Debit that to make it go up. What else do I have more of? Common stock. My credit to common stock is going to be for the number of shares times the par value. To make it balance, I need another credit that goes to my PIC in excess of par. So debit cash for what I get, credit common stock for the number of shares times the par value. The extra goes to PIC in excess of par. And this question was, does it matter which credit comes first? It really doesn't. So if you want to do the credit PIC in excess, that's fine. If you have multiple debits or multiple credits, they can come in any order you want. Now let's issue 50 shares of $10 par value preferred stock for $500 total. 500 divided by 50 says we're getting, what, $10 a share for it? It has a par value of $10 per share. So will we have any PIC in excess in this case? No. What do I have more of? Cash and asset goes up with a debit. Good. What else do I have more of? Preferred stock. My credit to preferred stock is going to be for the number of shares times the par value. So if it's preferred and not common, we simply change that one word. Instead of crediting common stock, we're now going to credit preferred stock. Not all stock has a par value. We said the par value is set in the charter. We could have a stated value, which is set by our board of directors. If we have a stated value and not a par value, we're going to treat it just the same. Instead of crediting common stock for the number of shares times the par value, we'll credit it for the number of shares times the stated value instead. If we get an excess, we won't call it PIC in excess of par. We'll call it PIC in excess of stated value. Just a matter of terminology. So we debit cash for what we get. We credit common or preferred stock for the number of shares times the stated value. The extra credit goes to PIC in excess of stated value. Let's issue 10 shares, common stock for $8 a share. No par value, but a stated value of $5 a share. Any excess involved? $3 a share. 8 minus 5. Let's make my journal entry. What do I have more of? Cash and asset goes up with the debit. I have $80 more cash. What else do I have more of? Common stock. My credit to the common stock is going to be for the number of shares times the stated value per share. Doesn't balance. We got more than that. The extra goes to PIC in excess of stated value. Some stock doesn't have a par value and it doesn't have a stated value. If that is the case, we're going to credit the stock account for the full amount. For the full amount. There is no PIC in excess because there's nothing to be in excess above. The total amount of the common or preferred stock account then becomes my legal capital. So we debit cash, we credit common stock or preferred stock. There is no PIC in excess if we don't have a par or stated value. Let's do another example. We issue 1,000 shares of common stock for $10,000. No par value, no stated value. What do I have more of? Cash and asset goes up with the debit. What else do I have more of? Common stock. Let's mention one thing. What if I told you that right now in our common stock account we had $500? That was the balance in my common stock account. And I also told you that my par value was $5 a share. So in my common stock account I have a $500 balance. Par value is $5 a share. How many shares must I have issued? 100. Because 500 divided by 5 says I must have issued 100 shares, because then I would have credited the stock account for 100 times 5 is $500. And I mention that because sometimes on your homework, they don't tell you how many shares they've issued. Instead, you're going to have to figure it. You're going to take what's in that common stock account, divide by the par value per share, and figure out how many shares they've issued. How about in a case like this? Is there any way to work backwards and see how many shares we've issued? Not if there's no par or stated value. There'd be nothing to divide by. In our last examples, we issued stock for cash. We could receive other assets or other services instead of receiving cash when we issue our stock. If that is the case, maybe I get some land, for example. I issue my stock and I receive land for it. When we receive cash, it was pretty obvious what amount to debit cash for. What if we receive an asset other than cash? We have to decide at what amount to record the asset at. The general rule is we're going to record the asset at its fair market value on the date that we get it. If we don't know the asset's fair market value, we estimate it. And the way we estimate it is to take the number of shares that I have given and multiply it by what each share of stock is worth, and that will estimate what that asset or other item might be worth. Forrest issues 20 shares, $10 par preferred stock to an attorney for their services in getting us incorporated. Fair market value of the services is $300. The cost of getting us incorporated are recorded in what account? The organization expenses is what we call the cost of getting us incorporated. So my debit here is going to go to organization expense, not to cash, but to organization expense. My credits work just the same as they did. We're going to credit what account here? My preferred stock, in this case. And the extra credit goes to PIC in excess of par. So in this case, I didn't get an asset, but I got services that we record as an expense. We're going to debit organization expense for the fair market value of those services, credit preferred stock for the par value, the extra credit goes to PIC in excess. So what do we do different here? If we didn't get cash for it, we don't debit cash, we debit whatever it is we get. The expense, if we got services for incorporating us. Let's do another example. Here we'll get a machine. I issue 1,000 shares, $1 par value, common stock for a machine. We don't know the fair market value of that machine. However, we know that our stock right now is trading for $15 a share. What asset are we going to debit? Not cash. We're not getting cash. What are we going to debit instead? Machinery or equipment. I don't care what you call it. So let's write down machinery or equipment, whatever you prefer. But then we need to know what amount. We don't know its fair market value, so instead we're going to have to guesstimate it. How much would you estimate that machine must be worth? $15,000. Why? Because the person selling it was willing to accept 1,000 shares of our common stock that they could turn around and immediately sell for $15 a share. That machine must be worth $15,000 then. So if we don't know the fair market value of the machine, we can estimate it. What if I told you that machine sold for a certain amount 3 years ago? Does that matter to us? No. Do we have an excess involved here? Well, $15 a share versus $1 a share. So we have an excess of $14 per share. Let's make a journal entry. Go to debit machine or equipment, whichever you choose. And it's going to be then for that $15,000. 1,000 shares times $15 each. It must be worth about $15,000. My credit's going to be just like if I issued it for cash. What's one account I need to credit? My common stock, okay, number of shares times the par value, and the extra goes to PIC in excess of par. Again, you could say 15,000 minus 1,000 is 14,000, or in excess of $14 per share times 1,000 shares. So if we don't get cash, we debit the asset, or perhaps even an expense if I receive services instead, for its fair market value on the date that we receive it. We may have to estimate that if we don't know it, the number of shares times what they're trading for today. The credits are just the same as if I had issued it for cash.